Gold, just the word, conjures images of wealth, security, and timeless beauty. For centuries, it has been a symbol of power, prosperity, and a hedge against uncertain times. From ancient civilizations to modern economies, gold has always held a special place in human history. But does gold truly live up to its glittering reputation as a safe haven for your hard-earned money, especially in the face of inflation? Can it really protect your wealth when other investments falter? Let's delve into the fascinating world of gold and uncover the truth behind its allure. We'll explore its historical significance, its role in modern finance, and its potential as an investment. Many people view gold as the ultimate store of value. It's a tangible asset you can hold in your hand, unlike stocks or bonds, which exist only as numbers on a screen. This physical presence gives gold a unique appeal. This tangibility gives gold a psychological appeal, particularly during times of economic turmoil. When markets are volatile and uncertainty looms, the solidity of gold can be reassuring. But we must remember that gold is not just a shiny metal. It's an investment, and like all investments, it carries risks and rewards. Its value can fluctuate, and it doesn't generate income like dividends or interest. Understanding these complexities is crucial before you consider making gold a part of your financial portfolio. It's important to weigh the potential benefits against the risks. Remember, investing is about making informed decisions. Knowledge is your best tool in navigating the financial landscape. So let's equip you with the knowledge you need to navigate the shimmering, sometimes treacherous terrain of gold. With the right information, you can make choices that align with your financial goals and risk tolerance. Inflation. It's a word that strikes fear into the hearts of savers and investors alike. The mere mention of it can send shivers down the spine of anyone who's worked hard to build their nest egg. Simply put, inflation is the rate at which prices for goods and services rise over time. This means that the cost of living increases and the value of money decreases. When inflation rears its ugly head, the purchasing power of your money diminishes. What you could buy for $1 today might cost you significantly more in the future. Think about it this way. If a loaf of bread costs $2 today and inflation is running at 3% annually next year, that same loaf of bread will cost you $2.06. Over a decade, this seemingly small increase can add up, making everyday items much more expensive. Over time, even small increases in prices can significantly erode the value of your savings. This slow and steady erosion can have a profound impact on your financial future, making it harder to achieve your long-term goals. This is where the concept of a hedge comes in. A hedge is a strategy used to protect your investments from the negative effects of inflation. A hedge is an investment that is expected to maintain or increase its value during periods of inflation, thereby offsetting the loss in purchasing power. Diversifying your portfolio with assets that traditionally perform well during inflationary times can be a smart move. Gold has traditionally been viewed as such a hedge. Its value often rises when inflation is high, making it a popular choice for those looking to protect their wealth. But is this reputation deserved, or is it more about perception than reality? The debate continues among financial experts and investors alike. Let's delve deeper into gold's historical relationship with inflation. By examining past trends and data, we can better understand whether gold truly serves as a reliable hedge against the eroding effects of inflation. Gold has a long and storied history as a safe haven asset dating back thousands of years. Ancient civilizations recognized gold's inherent value, using it as a form of currency and a store of wealth. Why gold? Gold is scarce, durable, and universally recognized. Unlike paper money, which can be printed at will by governments, the supply of gold is limited. This finite supply contributes to gold's perceived value and its ability to hold its worth over long periods. Throughout history, during times of economic upheaval, war, or political instability, people have flocked to gold as a safe haven. When currencies collapse, gold often retains its value or even appreciates as investors seek tangible assets. However, it's crucial to note that this historical relationship between gold and inflation is not always linear or predictable. Gold prices can be volatile, especially in the short term, and there have been periods when gold has not kept pace with inflation. Section 4. The glimmering mirage, short-term volatility in gold. While gold is often touted as a safe haven, it's essential to remember that gold prices can be volatile, particularly in the short term. The price of gold is influenced by a complex interplay of factors, including supply and demand, investor sentiment, currency fluctuations, and global events. During periods of economic uncertainty, investors often flock to gold as a safe haven, driving up its price. Conversely, when the economy is strong and investors are more confident, demand for gold may decline, leading to price drops. This short-term volatility can be unnerving for investors seeking immediate protection from inflation. It's crucial to remember that gold is a long-term investment and should be viewed as part of a diversified portfolio. Understanding the factors that drive gold prices is essential for making informed investment decisions. Let's explore some of these key drivers in more detail. Section 5. Decoding the dance of gold prices, central banks, supply and demand. The price of gold, like any commodity, is influenced by the fundamental principles of supply and demand. This means that when demand for gold increases, its price tends to rise, and when demand decreases, the price falls. Similarly, if the supply of gold increases, the price may drop, and if the supply decreases, the price may rise. However, unlike other commodities such as oil or wheat, which have industrial uses, gold's value is primarily driven by investor sentiment. Investors often view gold as a safe haven asset, especially during times of economic uncertainty or market volatility. This perception can lead to significant fluctuations in gold prices based on changes in investor confidence and market conditions. Central banks play a significant role in influencing the price of gold. These institutions hold large reserves of gold as part of their monetary policy strategies. Their actions, whether buying or selling gold, can send strong signals to the market and influence investor behavior. Central banks hold vast reserves of gold, and their buying or selling activity can impact market prices. For instance, when central banks decide to increase their gold reserves, it often indicates a lack of confidence in paper currencies, which can drive up demand for gold and subsequently its price. When central banks increase their gold holdings, it often signals a lack of confidence in paper currencies and can drive up demand for gold. This action is seen as a hedge against inflation or currency devaluation, making gold more attractive to investors. On the supply side, gold mining production and recycling rates also contribute to price fluctuations. The amount of gold mined each year and the efficiency of recycling processes can affect the overall supply of gold in the market. Discoveries of new gold deposits or advancements in mining technology can increase supply, potentially putting downward pressure on prices. Innovations in mining techniques can make it easier and more cost-effective to extract gold, leading to an increase in supply. Conversely, disruptions to mining operations or geopolitical instability in gold-producing regions can restrict supply and lead to price increases. Events such as labor strikes, natural disasters, or political conflicts can significantly impact gold production and supply chains. Understanding the interplay between central bank policies, supply and demand is crucial for navigating the complexities of gold price movements. Investors and analysts must consider a wide range of factors, including economic indicators, geopolitical events, and market sentiment, to make informed decisions about gold investments.